Ben Bernanke, Federal Reserve Chief. Now, we've assembled a taking stock think tank in order to assess the Fed's policy moves. With me now, Chuck Lieberman, Chief Investment Officer at Advisors Capital Management. Chuck is a former chief economist at Chase Manhattan Bank, former economist at the Federal Reserve Bank, and a former senior economist at Morgan Stanley. So he's got a lot of economists in his background. And we also have Rick Bensignor. He's the chief market strategist at Dahlman Rose. He is the former chief technical strategist at Morgan Stanley. Boy, a great pedigree from both of you, so we got a lot covered. Chuck, you listened to Federal Reserve Chief Ben Bernanke's speech today and also his answering of questions, because he did give that opening statement. Were you surprised by anything? How'd he do?
I thought he did spectacularly well. I wasn't surprised by anything. I thought the quality of his answers was very, very good. It wasn't just a brief response. It was a logical response, providing backup concepts to a lot of the answers. The question with Mike McKee was a perfect example of it. So I thought it was a great performance, a very strong articulation of why the Fed is still concerned about the economy. First and foremost, it's the pace of growth. It's the pace of recovery. They've got to get the unemployment rate down. It's presumptuous to start worrying about inflation problems somewhere down the road if right now we still have a high unemployment rate.
Rick Bensignor, presumptuous to worry about inflation right now when gasoline is over $4 a gallon in many places?
I don't think at all, really, Pimm. You talk to most people out there. I think most people are concerned about inflation. I think Bernanke tried to temper expectations of higher inflation in the future, saying at least it should be a temporary event, not a
transitory, right?
That was his word. If you look at the market's reaction to today's press conference afterwards,
stocks went up?
Stocks went up, but look at silver rallied 7% in total by days, and gold was up $23, something
right,
we're
over $1,500 an ounce.
So I think there really still are expectations of inflation coming in the future, and if you do some analysis on these markets, both of these major precious metals really could go considerably higher. It's tough to think that we're not going to have inflation to stick around for a while, and let alone go into a supermarket, see what you pay for basic things. A couple of weeks ago, I walked into a CVS. I couldn't believe basic goods, toothbrushes, deodorant, tissues. The prices have moved.
We got to get you to shop online, Rick Bensignor. So, gentlemen, during the break, I had to almost separate you a little bit because, Rick, you're saying that the Federal Reserve Chief obviously does not shop at CVS because he doesn't see the rising price that most people have to pay for basic stuff, things that we need on a daily basis.
Or my supermarket or my gasoline station on the corner.
All right, so he doesn't see it because, according to Chuck Lieberman, you don't necessarily want to be looking at commodity price inflation or commodity prices because that is a temporary or transitory effect in the overall economy.
As Bernanke said himself, the Fed does not supply oil. So no matter how hard they work the printing press, they're not going to increase the supply of gasoline. They're not going to be able to push gasoline prices down. So by inference, if gasoline prices are rising, and that's a problem, what Rick would like the Fed to do is to raise interest rates to squeeze the rest of the economy so that inflation in the rest of the economy remains mute enough to offset the upward pressure on energy prices. I don't get that. I don't think that's appropriate policy.
Is that what you want him to do,
No.
or do you just want him to admit that there's a lot more inflation in the system and he can still keep rates where they are, but say, you know what, and we have the rates at these low levels not because of inflation, but because we're trying to make sure that the economy doesn't falter?
Well, I'm not suggesting they move them higher. I would suggest that we don't keep throwing free money at the economy. QE1 was a necessary thing to do to save the world from dramatic collapse at the time it happened. QE2 was questionable, but seemed to have worked well. If we happen to go down the path of QE3, that I would say is, I don't want to use the word egregious, but I would say that is going way beyond what the normal plans of what a Fed chairman should be doing as far as just continually throwing money at the market. I'd say you've got to give many months, if not a full year, to let QE2 really pan through the system and see what it's done. At the very least, equity prices have moved up significantly. And whether it's correct or not, most people will look at the prices of the equity market relative to where they've been and when they're higher than they were at some past point. they tend to get more comfortable with their own spending and their own comfort
Well,
level.
sure. It's the wealth effect, right? I mean, Chuck Lieberman, I mean, if you see stock prices go up and you happen to be a stockholder, you feel good about the world.
Well, that happens to be what I wrote my doctoral dissertation on, the wealth effect. And we're seeing the impact of it. Consumers are feeling better. But critically, as Bernanke himself said, the pace of job growth has improved. It's still not adequate. We still have an unemployment rate that's quite high. It would be presumptuous, again, I'll use the same word, presumptuous for the Fed to start raising rates when the unemployment rate is still so high. There's a lot of slack in the economy. And when there's this much slack, underlying inflation pressures, as evidenced from the behavior of wage rates, are just not going up.
All right, but doesn't that present a sort of conundrum? Because on the one hand, if you're talking about wage rates not going up, in some cases going down because there is excess labor, particularly in the housing market. So now you have people that don't have wages increasing to meet increasing, perhaps transitory costs.
Energy costs, which is exactly a concern that Bernanke expressed. He said that rising energy costs take buying power out of the consumer, right, and that threatens the economy. So why are we thinking that the Fed should be tightening policy at this point? It doesn't make any sense. I'm not arguing that the Fed should be easing policy. The Fed also recognizes that there are fears of inflation out there. Rick's expression of that is very clear. So the Fed has got to fine-tune that balance, find a middle road somehow between scaring people worried about inflation and yet providing enough support for the economy. So they're walking that fine line. They're leaving policy where it is. They're going to continue to buy replacement securities to reflect the payoff on the bonds that are maturing. But otherwise, they're basically letting the economy run at this point.
Rick Bensignor, so given this scenario and the fact that I know that we're not going to resolve your differences, what should investors be doing right now?
I think not a lot's going to really change in the equity market, which means probably low volatility, low volume, but a slow grind higher. So if you're long the market, continue to stay long. There's not much evidence of why not to be, other than the macro events that we all know have existed for months and months, so nothing new has changed that, and the market has always seemed to get past any one of these exogenous events that have come. So stay long and perhaps take some incremental dollars and add, but I would not be a rampant bull here, but I'd kind of be comfortable with what I have invested and maybe put a little more in.
Chuck Lieberman, I mean, do you buy that scenario? Because it seems as though we can get to the same place, but through different routes here.
Well, I'm a little more bullish than Rick is. I think the market is fundamentally cheap. I think it's cheap partly because there are a lot of people who are still suffering from the scars of 2008, and so it's tough for them to get back in the market. We barely see flows into mutual funds, into stock mutual funds.
Retail investors.
They're still out of the market, so there's a tremendous amount of capital still parked on the sideline. Valuations are cheap. If we have moderate economic growth, that means corporate profits will continue to grow, and that's very positive for stocks, and it also means that interest rates will also stay pretty moderate. If you run any dividend discount model, as I'm sure Rick has seen plenty of them, you almost have to beat it with a rubber hose to make it come up with a result that doesn't suggest stock prices ought to be substantially higher. You've got to assume interest rates are going to be a lot higher than they are, or corporate earnings are going to be lower than anyone is reasonably projecting them to be. So I think the underlying support for stocks is very strong. And then the question is, how do you play it? And I think the right way to play it is in the more cyclically sensitive parts of the market.
Consumer discretionaries, right?
Consumer discretionary, where we have a lot of exposure, industrials, materials, all of these cyclical components.
All right, we're going to let you guys fight this out amongst yourselves. I want to thank you both very much. Chuck Lieberman, Advisors Capital Management, is always a pleasure. Rick Bensignor, always appreciate your contribution coming to us from Dahlman Rose. Wonderful.